We've got Rick Bensignor with us, and it's always great to have guests on. And I know you've got an awesome background in the financial services industry, Rick, and everyone's been waiting patiently for your presentation. What do you have for us today?
Well, Tom, we're going to look at some of the most important things any trader or investor needs to prepare with and the approach they need to take in order to set themselves up for much higher odds of success. And what's interesting is we'll take a look through this. And as we do it, the interesting thing is that you can be an advanced trader and someone who is quite sophisticated and yet sometimes forgets the most simplest of things to do to ensure or simply up the odds that what you're doing is correct. So we'll go through this slide deck, and what we're going to do is try to make our way through this rather quickly because we have a bunch of slides. We'll try to get this done in 15 minutes or give or take, and then leave plenty of time for Q&A. So let's start this off with a basic question and kind of how you approach things. Let's assume you've done some type of fundamental research. You kind of know what you want to do in the stock. And we'll assume it's a stock, but it can be anything in any of the asset classes. But once you've kind of got your security lined up, I think the single most important question to ask yourself is my intention here that this is going to be a trade, or is it a longer term investment? And it's critical that you've got to know the answer to this at the time that you commit capital. It's certainly less likely that if you've got a profitable trade, it's going to become a long-term investment. But it's very likely that if you intended to get into a trade and it's not working out and it's going against you, you might very well say, oh, well, yeah, this was intended to be an investment. And that's one of the worst things you can do to yourself from a money management perspective. So I want to walk you through what I think are 5 critical steps in order to really line up your trades right and really up the odds that what you're doing is correct, to really give yourself a chance. You know, when you think about, many people say it's a 50-50 flip of a coin whether or not a trade works because it either goes up or it goes down. I don't like to think of terms in the market as a 50-50 trade. First of all, we know that over time, stocks move up. If you look at any long-term chart of the Dow or the S&P, you look back 50 years, you look back 100 years, basically that chart's going to start on the lower left-hand corner and end on the upper right-hand corner. So it's really not a 50-50 flip of a coin in the sense that over time, most stocks move higher. What step number 1 is about is making sure that the time frame that you're going to analyze matches the intended holding period. And the key thing here is you don't want to mismatch a trade with analysis that you would do for an investment and vice versa. So you're not going to want to look at long-term charts if you're planning on holding a stock for a couple of weeks. And conversely, you don't want to look at an intraday chart and try to find a breakout if your intention is to hold the stock as an investment for multi months, if not years. So let's look at this in terms of a chart. Here's your long-term chart of Walmart. It's a monthly chart. And you can notice that from basically 2000 to 2012, Walmart traded in a range. And then at the very beginning of 2012, it broke out towards the upside. And this is a name that I myself actually bought in my personal account at $64 and change back in 2012. And I can tell you that I didn't spend much time at all trying to figure out entry. I looked at this, I assumed that at this point it was very likely that it was going to take out the all-time high from 1999. So I wasn't spending any time on figuring out where's the best entry. I didn't care if it hit 63.5 or 64, 64.5. I had a feeling that this thing was going to move. So again, I'm not going to waste my time looking to really perfectly define an entry on something that really should move. And just kind of as an aside here, obviously it moved up to 80 bucks, or actually that's $90 before it fell down. And that moved back down into the range that caught the 200-week moving average, or actually it's 200-month moving average. I actually got my wife into it. I suggested to her to buy it there. So she actually ended up with better entry than I did, although I had sold half out at 75. It's the type thing that, more importantly, is I matched my time frame to my analysis and spent very little time on actual entry. On the flip side of this is, let's say you're trading a name like Micron, and you notice that back on May 31st, this gap lower, and then twice tested that high near, let's say, 60 and a quarter. You had one more decline on the open of, I guess this was June 8th. And then we started breaking out towards the upside. And once we took out the triple high, to me, as a trader, that's your clue that you're going to likely move higher, especially with the spike down it had to start the day that got totally rejected, basically held below from 2 days before, turned around and went straight back up. So you notice, too, that you've got a big gap. And as a trader, after 3 attempts up, your target should be the high end of the gap, which is exactly where this went to. And then it's pulled back. And in fact, over the last couple of days, we've kind of bottomed back against what had been the breakout point. So you can see, as a trader, you want to use short-term charts and want to match my analysis to the type trade intention I have. If I'm investing long-term in Micron, I'm wasting time looking at a 15-minute chart and trying to perfectly identify where entry is. So the most important thing here is to match your analysis with the type trade that you intend to have. Is it a trade or is it an investment? Step 2, determine the prevailing trend direction and key support and resistance levels. Now, I'm going to tell you that it's not always as easy to simply look to see if price is moving higher or lower to say, is this trending higher or not? I always suggest that you find some type of model that helps take your own bias out of the equation. So it's not simply you looking at a chart and saying, oh, this is a bull market or not. A model that doesn't care how you think, but actually in and of itself creates bullish or bearish structure, I think is a helpful tool. So this is a chart of gold that I put into the slide deck earlier this morning. And if I ask you the question, is this a bullish chart or a bearish chart? I'm going to tell you, you're going to have a difficult time answering it. So let's add a little bit of analytics on to see if we can help. So taking the same chart, now we've drawn a few trend lines. And you can see, obviously, gold has spent 2018 in a channel until a few weeks ago where it broke down. But we're still holding on to, including today, the longer-term uptrend. So as analysis, you ask yourself, is this a bullish chart or should I play it bearishly? And I'll tell you, you probably still don't have the answer, even doing this simple type analysis. So now what I want to do is add something like the cloud chart on, which is one of my favorite indicators to help tell me the structure of a market. But still in this daily time frame, and by the way, on top where it says DC, that's daily continuous. So this is a rolling futures contract on a daily basis. Even this is somewhat unclear. Short term, the chart will tell you from the cloud chart that you're in a bearish market. But because the cloud itself has flipped so many times over the last few months, even that, I will tell you, indicates that it's choppy, and I give less credence to actually still being able to identify if we're in a bullish or bearish market. So I'm forced to essentially go out to a weekly chart. Now, if I look at a weekly chart, I can see not only did the cloud chart very well define the up moves from 2009 to 2012, and it got bearish in 2013 and then bullish again in 2016. If I blow this up to look more closely, I will tell you that gold is in, at least in the medium term, my perspective would be that you're still in a bull market despite the fact that it has topped multiple times north of 1360. The structure of the cloud chart, again, something objective, suggests that we're still in a bull market in a bigger picture, and would be until you got down to maybe something like 12.40 or so, another $50, give or take, $60 from where we are now. So again, I'm going to flip back to, it's really important to determine what's the prevailing trend. And you do that because now we go to step 3. Once you've concluded, am I trading or am I putting on an investment? And secondly, what's the prevailing trend and where are support and resistance levels? Now I can decide what are the most sensible technical indicators to use for the present market mode. Meaning, am I going to use trending models that help me define trend? And if we're in a trending market, I'm going to want to use that. Or are we in a sideways market that's not really going anywhere, in which case I want to use models that help me define more accurately highs and lows in non-trending markets, things like oscillators. So I want to show you a chart that I've shown multiple times in the last couple of years at lots of presentations I've done and conferences I've spoken at. This is the S&P from most of it, let's say 2014 through the fall of 2016. And obviously we had multiple lows just north of 1800. That's the lower horizontal green line. So that had helped support. We broke out in the summer of 2016 to new highs. And then that dip you see on the far right side of the chart is going into elections, the presidential elections in 2016. So on the breakdown back beneath support, many technicians on the street called for the high being in place at 2200 or so, and that this was breaking down. And it shouldn't have done that, and it shouldn't have taken out that prior support level, which used to be resistance at 22 and change. I'm sorry, 21 and change. And a lot of people got negative on this. Now you get the election results, and right away, obviously election night, market got hit very hard, but it crawled back. And by the next day or two, this thing started moving to the upside, right? I would suggest to you that that was a clear indication that trend had not in fact changed. We were back to essentially what had been the all-time highs just within days after the election, and that most likely you want to play this as a trend. And obviously, if we look at the results since then and we focus again on election week in the middle of the chart, you know how much this has moved up since. So you look at 2017, you have a pure up market. I purposely included RSI and MACD beneath this chart to show you just how poorly you would have done if you listened to the RSI to tell you you were overbought and should not be involved. And if you look and kind of really understand how MACD works, MACD never got a buy signal throughout the entire up move. There are signals that would tell you not to be short, but you never got a pure buy signal. And even over the last few weeks, the crossing of the blue line above the red line is not a pure MACD buy signal because it came from north of the 0 line. So again, it's another indication not to be bearish, and chances are in a long-term bull market, not to be bearish probably means you can be bullish. But using oscillators in a trending market had not been helpful, certainly from the latter part of 2016 and into 2017. So again, the whole point here is know which type mode you're in and use the right type models for it. Any type trend following model, whether it's moving averages, Ichimoku, anything that you like, EDX, that is going to help define trend, and that you're actually in a trend is the next logical step to use once you define that it's that the breakout, the false breakdown from election night and the move within 2-3 weeks right away to new all-time highs was your clue that this was resuming a new uptrend, and forget what the oscillators are telling you and instead play the trend. Step number 4 of the 5, determine achievable price targets, and then actually reduce or completely exit your trade when you get there. And the little subheading here, read this, this is important. If you buy a stock at 40 and you set for all the different analysis you do, your target is $50, And then you do nothing when it hits 50 because the stock looks so great then that you think it's going to 55 or 60. Nothing worse to you, to your P&L, and to your psyche to see it trade 51 and then plunk down to 45 because you got greedy and you did nothing when you achieved your price target. It's really important that you determine achievable price targets at the time you get into a trade, and then when you get there, take money off the table. Here's an example of a trade we put on for clients in 2016. In September or early October, kind of the middle of the chart, there's a DeMark model running on here called sequential, and this is the setup count. So the 9 count that you see in yellow up against the top of the Ichimoku cloud was a place we got short. So we actually sold the high of the move in TLT, but this was only intended to be a trade. And we were out of it by the time we got the 9 down, just essentially 9 weeks later. And I've had people say to me, you know, you had the perfect sale in bonds, and the TLT is now trading, you know, much lower, and it's actually probably right now TLT is at 119 and change. It's not a heck of a lot lower than this chart is showing, but this chart only takes you into the latter part of 2016. It fell much more before bouncing. And my response was, this was only intended to be a trade. I did not put this on as an investment. So when I achieved my downside target, I took it. And I don't kick myself in the butt for saying, oh, you missed all this. It was never my intention to be short for a mega move. I saw a very clear place to put on a low risk short. I covered at the intended cover point, and that was it, trade done. I can always get back in, but the point is, when I hit my targets, I took my profits. Here's the dollar index. Now, this is probably the best macro call we've had this year. We've been telling clients for months that in between 89 and 90 and a half to cover shorts, and aggressive traders go long for a 94.20 target. And we got that with virtually no drawdown. We picked the bottom to the move, and we hit our target a couple weeks ago, and that's it. I'm out. We're out at 94.20. We essentially bought the low of the year and sold, for all practical purposes, the high of the year. That's it. I will reanalyze. I will figure out where I'm more interested in coming back to the dollar. If I'm correct in this 5-wave move down, right, this is probably, and it's questionable whether or not we just did an EBC and the recent high was the C, or if this was just simply the A, we pull back and still have one more move. Nonetheless, I can tell you right here, right now, I'm not interested in being long the dollar. I've hit my target. I'll wait for a pullback before I decide if I want to come in. Most important thing is I set a target. We achieved our target. We took our profits. The last step goes a little bit more into the psychology side of things, and that is when your gut instinct first, and I highlight first, tells you that your trade is likely wrong, right? Your body's incredible advanced warning protection system is your gut instinct. Think of it as your AWACS system. When it tells you something's wrong with the trade you've put on, if you were to react when it first tells you that and get out of the trade, despite the fact that you might have bought something and a week later you're kicking it out, and yes, you have to come to the fact that you made a mistake and you're losing money. If you listen to your gut knows better than virtually anything else if the trade you've gotten into is the right thing or not. In the long run, if you get out, as soon as your body tells you something's not right here, you will likely save a vast amount of money and emotional turmoil that you have from trading. Both are really important things to have conquered to be a successful trader, right? So you don't want emotional turmoil. You don't want financial suffering. Listen to your gut. It knows best. So again, to recap, make sure the chart timeframes you're analyzing match the intended holding period. Figure out the prevailing trend and where the support and resistance levels are. Determine, are you using trend following models or oscillators that essentially fight trend to analyze the market? Figure out what your price targets are when you get them. at minimum, reduce, right? Take profits or completely exit your trade. And when your gut instinct first tells you that your trade is likely wrong, listen to your body and get out of the trade. In 2017, doing all these things, we put up in the No Trader, which is the service I have for individual clients. Most of what I do, or I consult to Wall Street institutions. But I also have a retail piece, a division of the whole Bensignor group. It's called In the No Trader. You can go to inthenotrader.com to learn more. Last year, we put on 39 trades. We accumulated total profit and internal rate of return of 75%. We used no leveraged ETFs. This is pure accumulation of profits over the 39 trades. Notice here on the right-hand side, the profit factor is 6.67. That means you make $6.67 following our trades for every dollar you lost. And on the left-hand side in the middle, look at the drawdown. 62% of all trades had drawdown of 0.5% or less. 41% of all trades had drawdown of 0.1% or less. It essentially means we had impeccable timing. And this does not include the option trades, in which case we only put out 2 last year, but we made 260% on those. If I look at how we just launched a brand new individual investor product called the Tactical Trader. It gives you the same information that I give on the U.S. equity markets to my institutional clients. It focuses on the individual investor piece. Only will do ETFs, unlike what I do for institutions. We try to choose ETFs from the top 100 most liquid ones. You can get this for as low as $99 a month if you sign up for an entire year and pay it once. Otherwise, it's $129 a month to month. And what I'll do is a special code. If you go to sign up and use the promo code StockCharts, I will guarantee this price of either $99 or $129 for the next 3 years, regardless of how much I raise the price for the individual product. So that's something I can offer you. Year to date, we just started the Tactical Trader Report April 5th. We've put out 7 trades, of which 5 of them are closed, and we're up 12.53% in that time. Notice first 4 trades had max drawdown 0. Every one we got into never closed a single day against us. And we've got a few positions on now. So again, you can go to In the No Trader, hit up the sign up tab. It looks like this. Choose either the top tab at $129 a month, and that's month by month, or you can pay the equivalent of $99 a month if you pay annually. So we'll bill you one time of $11.88. And again, don't forget to put in the promo code. And that is it from me. I will pass it back to Tom and Aaron for questions.
Well, I have a question, but I'm going to first see, Aaron, do you have any from the chat room?
Yes, we absolutely do. One I thought was really interesting is that have you ever thought about, once you hit a target, moving to a trailing stop instead? I mean, would that be a good strategy?
You could certainly trail a stop. I typically like the idea of taking something off the table when I hit my target. And generally, I'm in the neighborhoods of 50% at a minimum. Yes, I can trail a stop. You've got to have really good reasons to think that your stock or your investment, whatever it is, your trade is really going to increase substantially, and it has nothing to do with anything you see on TV. You read a newspaper. It needs to be because your analysis has changed such that if you were going to first put capital into play right then and there, you'd have a higher target. If you're not comfortable buying at the same price that you were originally looking to sell, then you should be selling.
Ah, that makes a lot of sense. The other was, how do you define, I'm sure it's just a matter of individuals' analysis, but, how do you really define what an achievable price target is, or what a good stop is if you're a trend follower or swing trader?
So here's where some of the experience I have is very different than a lot of people on the streets and certainly a lot of individual investors. Stop losses, putting in a proper stop loss, takes as much talent, if not more talent, than getting into your trade initially. I rarely will ever have a stop loss at an obvious point that I know other people are looking at. So I don't stop myself out under, last week's low. I don't do anything that is obvious, but it still needs to be within the context of what makes sense for my investment. So we don't have time today to go into how I come up with them, but there's certain mathematical relationships that I can look at about price movement that can help me figure out a proper stop. So on the stop side, that's how I can answer the question. As far as what are logical targets, okay. So this is a model. This is that dollar index trade. There's a model I use that basically said that when the price of the dollar index properly hurdled where those kind of green upward arrows were, just above the consolidation at the bottom, it would target the teal colored. So this is a model called TD propulsion. It works on the physics of price movement. And this is one of the ways I can come up with a target that's way in advance of ever seeing price move. Because it already gives me the levels that need to, that if we pass through A, there should be enough momentum to get to B. And that's one of the ways. Ichimoku, the cloud charts are a very good way of establishing price targets too. Because unlike almost any other technical indicator, Ichimoku looks forward in time 26 price bars and plots already forward in time. So if you're talking a daily chart, you've got 26 days ahead. If you're looking at a weekly chart, you already know 6 months beforehand where important support and resistance can be. So that's how I come up with achievable targets.
Okay. That's all I had from the chat room at this point. I kind of consolidated all those questions. Tom, did you have anything?
Yeah, I've got one question, and maybe while we're going over it, if we can bring up that poll again so we can kind of close out with that in just a minute. Yeah, my question is, you were talking earlier about, using, if you're a fairly short-term trader, you don't want to be pulling up a monthly chart to try to determine where you're going to get into a stock. Or if you're a long-term investor, going to a 15-minute chart probably doesn't make a whole lot of sense. I guess into a trade, I almost always enter based on either an hourly or daily chart. Typically a daily chart. I'm a swing trader. I tend to hold anywhere from, it could be 1 or 2 days if things go against me and I have to get out, or I have a quick trip up to my target. But normally I would say it's a few weeks to a month is kind of like my normal holding period. Now, when I look at my daily charts, I will many times go back to a weekly chart just as confirmation of maybe the overall trend to the upside to make sure I'm trading in the right direction with the longer term chart direction, even though I'm actually using the daily chart to pick out my entry points. Do you do that, or do you simply stick with that daily chart for swing trading?
I think for swing trading, because I identify swing trading as typically something in the few weeks to maybe a month and a half time frame. I think of swing trading as really trying to take advantage of whatever the next move is. And I think because of that time element that is the typical holding period, looking out at longer term charts, you kind of want to know what they say, but if think of it this way, you have a solid uptrend over time, but you have enough evidence to think that for the next month, the stock's pulling back. It's already started to, show some signs of weariness. It's starting to break down. You say, if it takes out this level, I want to get short, you get short. You're shorting something that in a longer term time frame is bullish, but if your analysis is correct and this thing still has a few weeks more of pressure to go, you pay attention to your daily chart. You look for what your targets are. It's possible some type of target comes in from a weekly chart, but my guess is the daily chart will probably give you what you need, if not even a 120-minute chart or something that gives you can look back a month or so and find prior low, or draw a trend line, or do something to create a target.
Okay, fair enough. I do want to point everyone to the poll. This was interesting. I found one of these answers to be very interesting, and that is the 12% that said none of the above.
Right, I noticed that too.
All right, so that's about 18 people. That's about 18 people that responded that's not using any of these things to get out of a trade. And I would like to now add like a blank as to what they're using if they're not using any of these. Maybe they're long-term holders and they don't.
Yeah.
They don't.
I was thinking too, some people honestly don't set stops and targets, so yeah, they must have something that helps them decide if they don't use the gut.
Well, I'll tell you what I think they use. They use the fact that they know over 100 years the market moves up. There are people who are they are only buyers of stocks. They do not sell. Their view is the asset class equities is always a long-term hold. And even if it doesn't work for 10 years, if you're a long-term holder, it will come back. And history has proven that. So, I think if the people who signed in for none of the above are truly there and have read through the question, then my guess is nothing's a trade. It's all an investment, and you simply don't get out.
Yeah, that makes
sense. And you hope that 3/4 of your names go up and way outpace the few that don't.
Yeah, personally, I think if that was an ETF, a diversified ETF, I'd be okay with that strategy. I think because you're right. I mean, I'm a historian, and obviously the markets come up a long way, and occasionally we go through bear markets, but we always come back out and move to higher highs. So that would be okay for me for an ETF. But when you look at individual names, I mean, there have been some big companies over the years, not many, but there have been some big companies over the years that have really fallen apart. And, a lot of big names that maybe weren't around for a long time, but a lot of those .com names from back in 2000.
Sure.
Or the old standard, General Electric. I mean, that one.
Yep. It's true, and you can think of. I mean, there's so many names. Go back to I think pre-split Yahoo's all-time high was, or maybe it was even post-split, 250, and it went from 250 down to $9.
Yep.
Yeah.
And, I mean,
it's painful.
Yeah. And look, there's some analysts on the street who won't downgrade their names no matter what they do. Mm-hmm. And, that's why you want to have some general sense of fundamental analysis, but I never pay too much attention to them, other than when you find an analyst who has downgraded a stock after taking a really bad loss. Let's say they get you in at $60 a share and they're puking it out at 35, and they're kind of the last guy on the street who hasn't already turned it into a hold or a sale. Generally, I'll wait 48 to 72 hours after that and buy the stock, because they almost always have sold the absolute bottom.
Mm-hmm. Before you go, somebody had asked what your model name is that you use. Is it just a personal one, or do you have a name for it?
The model name I use, I use multiple models. It's when the person's asking what's the model name, are they talking about, for instance, that dollar index chart that gave us, targets?
Yeah. Yes.
Okay. So that's actually a model from a gentleman named Tom DeMark. It's the propulsion model. And to access, the thing is, DeMark's models are not free anywhere. They're $500 a month. So you need to be a serious, investor / trader to invest in them. They're definitely part of my repertoire. I use other models besides Tom's, but Tom's models are often very helpful to me. So As somebody who is a consultant to institutions and I'm talking with them all day long, I want to know what some of those models are saying. But if you were to ask me, like, what am I when I pull up a chart, what am I always looking at? I'll have a DeMark sequential count. I'll have a DeMark propulsion overlay. I will have Ichimoku, which is the cloud charts. And generally, I'll have a MACD chart running on the bottom. And again, I don't make trade decisions for MACD. But if I'm already looking to get bullish, and MACD has stopped going down and is very short shortly to turn positive, I may already go after it, or I may wait for MACD to confirm. But I'm never going to buy something just because MACD says, oh, it's a buy. I've got to have my own reasons. I don't believe enough in any of the technical indicators that in and of themselves that you're going to make money in the long run simply trading an individual indicator.
Right.
And I think something like RSI will prove that to you. Do you know that Larry Williams had years ago figured out that when the RSI gets to, let's say, 70, it's often the best time to be a buyer. Whereas most people will read a textbook or take a class on technical analysis and learn that, you want to sell it when it gets overbought and buy it when it gets oversold. It's not true at all.
Mm-hmm.
You have to know what market mode you're in. In a sideways market, sure, sell the, moves above 75, buy the moves beneath 25. In a trending market, let's say you have an upward trending market, I couldn't care less that RSI is overbought. I'll only care if it gets oversold. Then it's probably, I want to find reasons to be a buyer.
Mm-hmm.
Right.
But in an upward trending market, your RSI should be overbought most of the time. If it's a good, solid, strong market, RSI should be very high. And if you're getting out of your trades because RSI is hitting that, you're missing a ton of upside action. You've got to know what the indicators actually are intended to do.
No doubt about it. Certainly all of these indicators, and like you said, many of these indicators really shouldn't be your go-to when it comes time to pull the trigger to buy or sell. It should really just be secondary type indicators.
Absolutely, Tom.
But anyway, it was absolutely wonderful having you on the show today, Rick. We certainly, it was a pleasure for us to have you, and we'd like to get you back sometime if your schedule frees up.
I'd be happy to come back, guys. It's a pleasure to share. I love educating people, and I'm always happy to come back.
So in the book itself, just so everybody knows, it's all StockCharts charts. It's all StockCharts setups. But I talk about why to use candlestick charts, why you might want to use line charts, bar charts, mountain charts like you'd see on the business news networks and those kind of channels. A lot of it is about the settings in StockCharts and how to make great charts. This is actually a book about building your base, understanding how to make the chart display the information you want, all of the little trick settings. I think it came out pretty well. So in the book, what I try to do is show how to get things set up, specifically about overlays and indicators, how to turn them on, how to change the settings, how to make them show up the way you want them to. And so if you're struggling with any of the sort of chart settings, that's an important part. With that, thanks everybody.
With 3 unique service levels and multiple data plans to choose from, StockCharts.com makes it easy to customize your account to best match your specific needs. In this video, we'll help you explore all the benefits of your membership by explaining our service levels, data plans, and pricing. Let's see how it works. To start, you'll want to choose from one of our 3 service levels: Basic, Extra, or Pro. Each service level represents a collection of features and options bundled together. If you're new to StockCharts, our basic service level is a great place to start. At $14.95 per month, Basic will allow you to create larger, more powerful charts and save them to your account. Next up is our Extra service level, the most popular choice among StockCharts users. At $24.95 per month, It includes all the features of our basic level, plus more saved chart storage and the ability to create custom scans and alerts. If you want it all, our Pro service level is for you. At only $39.95 per month, Pro includes even more storage for your saved charts, custom scans and alerts, as well as faster auto refresh, historical data, and much more. For all service levels, you can choose to subscribe on either a monthly or an annual basis. Our monthly renewal option is similar to most other web-based subscription services. You pay for 1 month of service at a time, and your account will simply renew automatically each month. With our annual renewal option, you prepay for 12 months of service and we'll give you the 13th month for free. If at any point you'd like to change your service level or renewal preferences, you can always do so from the Your Account page. Now that you've chosen a service level, let's find a data plan that works best for you. Regardless of service level, all StockCharts accounts come standard with our free data plan, which uses BATS real-time data for the US and delayed data for all other markets. However, if you want to enhance your StockCharts experience even more, you can customize your account by adding official real-time data plans for one or more of the stock exchanges we support. Similar to exchange fees, prices for each plan vary, as they reflect the fees charged by the exchanges for your use of the real-time data. We want to make sure you have the data that's right for you, so our data plans are flexible and can be added or removed at any time. Keep in mind that all real-time data plans are billed separately from your service level subscription and always on a monthly basis. Unless removed from your account, data plans renew automatically at the end of each billing month. If you do choose to remove a plan, the change will take effect at the end of the month. All data plan charges are non-refundable. To explore all our data plans and update your preferences, visit the Your Account page. StockCharts.com gives you the charting tools and resources you need to invest smarter. And now with the flexibility to customize your service level, renewal cycle, and data plans, we make it easy to find the account options that are just right for you. Take control of your investing in just a few simple clicks with StockCharts.com. Simply the web's best financial charts.
Here's how to put a simple line on your chart without using the annotation tool. Let's say we want a line in here at 47.50. You can just drop down here into the overlays, pick horizontal line, add the price point, 47.5, and we're going to use a red line. We're going to make it solid and thick and hit update, and that blasts it into the middle of your chart.
You've got a problem. Your investments aren't growing as fast as you'd like. So you did a smart thing. You opened an online brokerage account and started learning more about the financial markets. But now you have a bunch of new questions, like, which stocks should I buy? When should I buy them? When should I sell them? You tried watching the talking heads on the financial channels, but they just gave you untimely advice that the real pros already knew about. It's all starting to feel a bit too little, too late. But what if there was a way to know, to truly know, what the market was thinking and how it was behaving, even before the pros? What if you could learn where the market was headed while there was still time to profit from that knowledge? With StockCharts.com, you can. Trusted by thousands of online investors, StockCharts.com has the charting tools and analysis resources you need to make smarter investing decisions. Our intuitive web-based tools make it easy to create high-quality financial charts in just a few simple clicks. Save and organize the charts you're watching to make managing your portfolio a breeze. And when it comes time to buy, our unique technical ranking system sifts through the markets and quickly points you to the most promising stocks and funds. You had a problem until you found the solution at StockCharts.com. Start your free 1-month trial today and see what superior financial charting can do for you. StockCharts.com, simply the web's best financial charts.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.